Morning, everybody. Good morning. I'm the lucky one to start everything off, so hopefully we can get our blood moving and get excited. We're going to talk about lending today. Again, my name is Seth Sundeen, and I'm an assistant vice president at Derry State Bank, where I specialize in secondary market lending. For those of you that are not familiar with Derry State Bank, we are a home loan leader in northwestern Wisconsin. We are also a direct seller servicer for Freddie Mac as well. So a lot of the information I'm going to present today is going to have a spin with Freddie Mac in there. It may deviate a little bit with some of the other programs such as FHA and VA, so keep that in mind as I kind of present. The topic of my presentation is residential financing update, very basic. We're going to kind of cover a gamut of different things, and if there's something I don't cover in the presentation you'd like more information on afterwards, please let me know. This is the agenda for today. We're going to talk about underwriting. We're going to talk about appraisals. We're also going to go over some important reminders as well as providing you with an economic and housing outlook. At the top of this here, I put back to basics, and that's kind of what's going on in the lending world. We're seeing a lot of shift back to basics with lending with some fundamentals. And really the goal of this presentation, I just want to reiterate, is to bring you up to speed with some of the changes that we're seeing, both in the lending programs and guidelines, and how those changes ultimately impact the real estate transaction as a whole. All right. So how did we get here? Obviously, there's been a lot of changes, as I said. Before we can really understand that, we have to understand what changes have gone on and how we got here. And like other facets of the real estate industry, residential lending has seen its fair share of changes. Many of those changes are a result of an economic downturn, coupled with unsustainable rises in real estate values, joblessness, things like that. All those economic factors have played into it. But in addition to that, 5-6 years ago, we had a lot of really lax underwriting standards. Programs that were out there that probably shouldn't have been out there, and they lent money to borrowers that maybe shouldn't have got loans, quite frankly. Some of the programs that are out there or that were out there back then were stated income programs. For those of you that are unfamiliar with stated income, a borrower could tell a lender, I make X amount of dollars in income, and really nothing was verified. No W-2s, no pay stubs. So ultimately you can imagine the challenges that are created with those stated income loans. In addition to that, there were loans that did 125% loan versus value. If you couple that with a declining real estate values as a whole, that creates a lot of issues ultimately. And then there's the exotic mortgages that were out there as well. So, there's the economic factors, it was the loan programs as a whole, and it just created issues. So what we're finding is that shift back to the fundamentals, back to the basics. And again, that's what we're going to talk about today. So we're going to talk about underwriting first. We're going to talk about the difference between pre-qualification and pre-approval. I think this is important because I have realtors from time to time that ask me what the difference is. A lot of them think they're one and the same. And at Derry State Bank, we don't feel that they are. Pre-qualification is really a surface-level fact-finding mission where we as a lender are going to ask borrower questions. What does your income look like? What is your down payment? What is your credit score? What do you think your credit score is? And based on the data they provide, right or wrong, or what they think it is, we're going to give them some information and saying, it sounds like you qualify for this, or this amount of loan on a purchase. Obviously, if they don't know their situation or they provide us data that isn't exactly accurate, it can create a problem. So what I would suggest, and what we do at Derry State Bank, is we do more of what we call a pre-approval when we issue that commitment letter. And that pre-approval is an in-depth analysis and interview where we're typically going to get an application. We're typically going to look at credit. We're going to look at W-2s, pay stubs, tax returns. And we're going to do a cash flow analysis and really get a good idea of where they stand as a whole. And it's really the same process we're going to do when we do an overall loan underwrite. And it's the whole process other than getting the appraisal, looking at title work. So it's really multiple stages just in the initial sitting with that borrower. And why I think this is important is those with realtors that work with their buyers, I encourage that you work with your lenders as well to have them do more of a pre-approval so they really have a better idea of where the borrower stands. Because ultimately it saves the borrower time, it saves the realtor time so you guys aren't spinning wheels, working with somebody to come to find out that they ultimately can't afford a property or there's some kind of skeletons in the closet that you weren't aware of because of credit. So we highly encourage that with that pre-approval aspect. With that at the bottom, I have a tip at the bottom I just put on here. And at Dairy State Bank, I just want to address that we encourage people to shop for a home loan. There is a lot of differences between lenders out there, so shopping for a home loan is encouraged. But some of the concerns that we find with borrowers is that when they want to shop for a home loan, they're worried that their credit's going to go down or it's going to be affected every time they go lender to lender. According to myfico.com, they say that you can shop for a home loan and run your credit within a 30-day span, and let's say you run it 4 or 5 times within a 30-day block of time. Typically that's viewed as one inquiry or one hard hit on your credit score. So ultimately, it's encouraged for borrowers to go ahead, shop for a home loan, do it in a short period of time, and kind of compare lenders and see what the best deal is. So why I'm mentioning this to those out here that are realtors, obviously you create that bond with your buyers, and they may come to you and ask questions. And obviously, one of those you may want to suggest to them is to have them shop around and provide that and to tell them that typically it does not affect their score as long as they do it within that shortened period of time and so that they can get the best deal. I also put out there that sometimes it's encouraged that borrowers, if they want to look at their credit report without seeing a lender first, they are entitled to a copy of their credit report free of charge by going to the website there, annualcreditreport.com. With that site, that's a government-sponsored site, they can get their score, and that will not affect their score with a hit or an inquiry on it whatsoever as well. So they can kind of get an idea before they come in to see the lender where they stand, what kind of things are on their credit at the beginning of the process. Another one that comes up that I've seen a little bit more questioning on is work history. I have two here, 2 topics. One is entering the workforce, and you can see the other one is re-entering. An example sometimes comes up when you have a borrower that maybe was in college and now they have since entered the working world. And the question comes up, do they qualify for a home loan? Because a lot of times with Freddie Mac and Fannie Mae, they want a 2-year work history. Well, that's okay a lot of times if you're a college student and you're now in your working field, as long as you've been in there for 6 months typically. We look for that 6-month window. And why we look at 6 months is because a lot of times you're out of that probationary period and you're really you're in that job and you're kind of locked into it. So students are fine typically that are now into their profession as long as they provide us typically with like a transcript showing that they were fresh out of college or a diploma. Another aspect, as I said, is re-entering the workforce. That would be a situation where a family member decides to stay home, let's say with some kids, and then ultimately they decide to go back to work years later. Again, that typically isn't a problem if they've been at their job for 6 months and that they've had a work history prior to that of at least 2 years at some point, so we can get kind of a baseline to work off of. So again, it's not that you have to have exactly a 2-year most previous work history, but ultimately 2 years that were established at some point and that you've been there for typically 6 months at your employer. The bottom tip here is, again, just to reiterate, it talks about looking for a 2-year work history and that we're looking that the income is to continue for 3 years, and we're trying to at least estimate that the income is to continue. So that's a Freddie Mac guideline specifically for secondary market. Additional factors when it comes to underwriting that we look at: large changes in deposit accounts. What I want to speak to with this would be down payments and cash reserves. A lot of the programs require at least 5% down of a borrower's own funds when they buy a house. That is unless they have at least 20% down, but in a lot of cases they don't have that. So A lot of the programs require 5% down of their borrower's own funds. If the borrower doesn't have that, what I would maybe suggest is if they've got money coming from mom and dad as a gift, we suggest that that money is given to the children prior to, put into their account, and let it kind of become part of their average balance or settle out, if you will. So maybe 1 to 2 months prior, get that money in that account, get those reserves built up, and then it's going to be part of their balance. Why that comes into play is because as lenders and as underwriters, we have to get bank statements, and we've got to look at large spikes or declines in balances that are large swings, and we've got to document what are the reasons for that. And ultimately, if we can't explain large deposits, that becomes an issue for underwriting and for qualification. So again, if there's any large surprises or large deposits, it's something that we would suggest that you encourage your borrowers to do prior to, if possible, to get that out of the way. Job changes, specifically with job changes here. Job changes are fine if they have kind of bouncing around between jobs, as long as the borrower can provide us with some type of letter of explanation why the change occurred, or maybe they've been off work, they've been laid off for 4 months, and now they're at a new job. Again, a letter of explanation what happened. Now they're back, and they basically have been actively looking for employment the whole time. So it's important to know that it's not going to be deal breakers, but ultimately we need to find some kind of common ground or explanation as to why that occurred and provide that in writing. The other aspect of this I want to talk about is a credit report. Going back to this again, what I want to talk about, a question comes up if a borrower has a bankruptcy or a foreclosure, do they qualify? Well, according to Freddie Mac, typically the waiting period for foreclosure is 7 years. But that could be reduced down to as little as, depending on their situation, to as little as 3 years. And a bankruptcy typically is a 4-year wait and be reduced down to as little as 2 years. So there's different circumstances for it, but typically the hard and fast numbers are 7 years for bankruptcy, 4 years for foreclosure. 7 years foreclosure, 4 years for bankruptcy. And again, some of that can be shortened up. I've been told with FHA loans and what I know and the limited knowledge that sometimes can be even shorter on FHA and some of those government entities as well for those backings, but for the fixed rate Fannie Freddies, that's kind of the waiting period on there. Total debt ratios, again, not getting to bore you with all the underwriting aspects with credit reports and debts. We look at really not to exceed probably 40 to 45% of your total income going to debts. Really the hard and fast numbers though are 28 and 36, 36% of your total income, but again it's a little flexible on there. The other part here that I put on is a tip at the bottom. Sometimes people wonder, well, how does my credit score come about? Where do they come up with that score? And I got to be honest, I don't think lenders even truly know fully how the scores come about, because there's a lot of mystery that comes to be with that. There's a very complicated scoring system that's out there. But just to give those an idea of the composition of a credit report and a credit score rather, it shows here that the credit score is based on 5 categories. And us as lenders, we typically look at an ideal score being 740 or higher for a FICO score. Little caveat there, a little sidebar. If you don't have a 740 FICO score, that doesn't mean that you're not going to get a loan. Typically, that means that you're going to have more in down payment, not down payment, in closing costs rather. So it could create more in closing costs if you have less than a 740. But nonetheless, it shows here 35% of your score is based on payment history. Another 30% is based on amounts owed. 15% is length of credit history. 10% is on new credit. And then 10% on length of or types of credit used. Some of the quickest ways to help improve your score, and it takes a lot to improve scores, but some of the quickest ways to improve your score in the immediate is to look at how much of a balance a borrower is using on a credit card, for example, or on a revolving line. If someone is using more than 50% of their credit limit, typically that will bring down their score. And the higher you go to that top peak, the more the score will go down. So one of the things that a borrower can do, or you can recommend to buyers if they have that question they ask realtors, is to really reduce the overall amount that they have advanced on credit lines and on credit cards. That will help dramatically. Another piece of that would be to avoid opening up new cards right around the time that you're getting a home loan. I mean, don't go out opening a Menards card or a Home Depot card before the home loan is closed. I would suggest that you wait until the transaction has gone through before you do that, because all those would be considered a hit on your score and bring down your scores. So really kind of hold off on some of those. We also like to see a good composition of different types of credit. Installment loans, like car loans, are good to have. Revolving credit is good to have as well, not just to have one in one particular category. Appraisals. What can I say about appraisals? Ultimately, there's continuing to be challenges with appraisals. I feel for all the appraisers that are out there. They have a tough job. There's just not a whole lot of sales to go by out there, and because of that, it makes it difficult to come up with good home values. And obviously, we know a lot of the homes that are selling really aren't the traditional arm's length transactions where there is just a regular buyer and seller. It's typically bank-owned properties or distressed properties, short sales. So that obviously brings down the total value and kind of the overall value of things. So we continue to struggle with lack of quality comparable sales. With that, we are finding that we have to expand sales dates when we're looking at appraisals. Typically in the past, we would look 3 to 6 months for taking comparables to look at to come up with values. But now we're expanding those sales and looking up to 12 months out on recent sales to pull for comparable sales. So again, we need to expand that to really get a bigger pool, even to get some of the data that we need. We are seeing excessive value adjustments. Obviously, if there's not a whole lot to compare to, there's a lot of adjustments that are occurring to try to make things fit. And it's very difficult, obviously, when we see adjustments when properties are truly not that alike in amenities or characteristics, and we find that there's all kinds of adjustments on comparables on the appraisal. So that becomes an issue. It's like taking a square peg and putting it in a round hole. It just doesn't work, but ultimately that's what we're seeing. Not to get into specifics, but typically we look at adjustments to be like a 10% net, and overall adjustment to be 25%. And what that means basically is that we kind of look at all the adjustments on any particular sale and comp and see how that compares to the subject. And we want to make sure that there's not too much deviation from the subject property. And so we want to try to keep those in line. And again, that continues to be a struggle. Greater distances. This is particularly a factor in rural properties. We're finding that rural properties, that the distances are further and further apart just because there isn't a whole lot of sales to choose from. So ultimately we're finding that we're having to expand the distances between properties that have sold. And again, that's something that we typically like to have them as close in proximity as we can to get a true representation of the market. But again, we're seeing that those are stretched out. Also, unique properties, those are always especially difficult, such as log homes, manufactured homes, homes on slabs. Again, we've got to compare homes that are like that subject property to really get a true value. So again, that becomes an issue when we don't have a pool of homes to choose from if we can't find those log homes that are out there, or we can't find those manufactured homes. So that continues to be a problem, and as more stability comes to the market, more sales occur, it's getting a little easier, but it's still an uphill battle. The bottom of this slide here, I just put a little reminder. Most banks and credit unions work off an approved appraiser list. What that means is we have no say typically of who does the appraisal. Ultimately, it's on a rotational basis of who's next on the appraiser list. So we get an offer, we get a transaction, and we basically have someone that's totally separate from the lending transaction order the appraisal, and they're gonna send it out to whoever's next on the appraiser. So on the appraiser list. So again, we have no control of that aspect, just so you're aware. Important reminders. This is one that I get a lot of. Personal property on the offer to purchase. If there's one thing I would have you leave today with, it would be to try to avoid having personal property over and above the norm, like certain appliances and certain stuff, certain fixtures on the offer to purchase. It's becoming more of an issue because ultimately we've got to factor in, okay, if you're going to leave a lawnmower, if you're going to leave a flat screen TV and you're going to leave stuff, even if you don't want to bring it to your next home, there's value there. And we've got to give a value for that personal property and factor that in. And ultimately, if it's on the offer, we typically would have to go in and figure out, okay, well, if the home is worth $100,000, if they have a purchase price was $100,000, but they left an additional $2,000 of over and above of personal property, we've got to kind of net that out of there and then base our loan amounts on that new figure of, let's say, 98. So it really isn't always a win-win for the borrower if they're getting all that stuff left to them, because ultimately we probably can't do a loan amount as much because we have to base it on a smaller purchase price. So ultimately, I would suggest leaving some of that personal property off the offer. Separate bill of sale would be a good idea. I don't know how everyone feels about that, but I would recommend something keeping it separate, or adding some verbiage on an addendum that says something to the effect that personal property is left as a convenience between the buyer and the seller, and it has no value. And I know that probably seems kind of, well, that doesn't make any sense, but that's one of the things as a workaround that we utilize anyways that Freddie Mac seems to be okay with. Again, using verbiage that says it has no value and it's left as a convenience. So we would suggest that as a piece of this, again, as a takeaway. Financing concessions, they're basically left unchanged for the most part. As you can see, based on loan versus value, there's a certain amount of financing concessions that can be allowable, and they really haven't changed too much over the years. All right, this next sheet here, economic and housing outlook. You have this in your flyer here, I believe, in your packet, and this is data that was provided to me from Freddie Mac. It's information that's out there, and they're the brightest minds at Freddie Mac. Their economists provide a housing outlook and some really pertinent information to kind of point out. And the data that's on here is February. Yours, I believe, is March, and there's one that even came out for April since then. But ultimately, with this, what you should be aware of is Freddie Mac economists believe that unemployment is continuing to decline, which is good, but it's a slow process. We're not going to see a whole lot of change through 2013, as you can kind of see. They believe that overall that interest rates will rise over the next 24 months, give or take. They are predicting that they could go as high as 5% by the end of 2013. Again, no way of knowing for sure, but keeping in mind that is kind of what they're slating, is that rates will rise, and we are at all-time lows right now, but ultimately that could change. Also in here, it talks about housing starts. They are predicting, and I'm sure we'll have a lot more talking about this stuff here coming up. Housing starts are going to improve and increase. Housing sales, they are factoring in that home appreciation is going to slowly increase. And that we are going to start to see more of a shift from where we've seen a lot of originations on the refinance side. We are going to see more going back to the purchase side. So we've seen almost probably 70% of loan volume on the refi side, and now we're going to slowly see that kind of trickle back down into kind of a proper mix of purchase and refinance as more people have kind of gone through that refinance process and as the market picks up a little bit. It's kind of neat to kind of look at some of this here. As you can kind of see to the far right, it gives you some totals through 2007 forward, and you can kind of see that there was a decline in overall conventional financing as a whole as far as loan volume out there, and there was a spike in FHA and government VA stuff. And what we're seeing now, though, is they're predicting that some of that's going to kind of die down a little bit on the FHA side. And that's been a real hot program going to this point, but we're starting to see FHA and some of these other programs kind of becoming a little bit more stringent, more down payment, They got private mortgage insurance and increases in MI with that. So we're seeing more of a shift on the conventional side. And the conventional is still very competitive because you can get into it for as little as 5% down. So again, a shift into more of that conventional stuff. So again, this is just for your information. This next slide is one that I got off realtytrack.com. And essentially what you can see here is it's foreclosure activity for St. Croix, Dunn, and Pierce counties. And this is a little bit of a deviation from the slide that you have in your packet. But specifically what you should see on the y-axis is it talks about the number of properties. On the x-axis, we've got the date range starting from May of 2011 through March of 2012. And ultimately what you should see here is the blue line indicates properties in St. Croix County. We are seeing a trend, according to RealtyTrack, of foreclosure properties still increasing in St. Croix County. However, we are seeing kind of a stabilization both in Dunn and Pierce counties. Dunn would be the orange. Pierce would be the red. There is a spike in the end, the Pierce at the end there, but we are seeing kind of a decline. But as a whole, it looks like Dunn and Pierce are more of a stabilizing stage, and St. Croix continues to be kind of a upward trend. So that's kind of interesting to see that kind of panning out there. Okay, the cost of waiting. This is one that I think is always kind of interesting to see. I always get buyers that say, you know what, I'm going to wait. I think prices are going to go down some more. They're going to fall. They're going to fall, and they have fallen. But I just wanted to kind of use this comparison here, and you probably have seen something similar in the past. In this example, on a purchase price of $150,000, if someone has 20% down with the present day, that'd be a down payment of $30,000. That would give you a loan amount of $120,000. Using rates today, which these are a little high, I gotta admit, because rates are a little bit below 4. But using rates of 4% today and 30 years, the total payment is roughly is going to be $573. Total interest on this, if a person were to pay the scheduled payment over the life of the loan, is going to be $86,000 and some change. And the total cost of the loan, approximately factoring in, is about $206,000, $243,000. If you look at the future example, let's just say they waited and they're going to save $10,000 on the purchase price, which is a great deal. That purchase price is now down to $140,000, down payment of $28,000, so you're not going to have to put down as much because that's a smaller purchase price. Loan amount is even less, being $112,000, again with a 20% down. We've got a rate of 5% though, so it's assuming the rates go up, and let's say it pops up to 5%, same term of 30 years, that payment is still going to be higher at $601 versus the payment of $573 at the 4% rate. So with that, we've got total interest on this example of $104 versus $86, factoring in the total cost of the loan to $216 versus the $206. But you may say, well, Seth, but they're saving $10,000. And that's true, they are. But even if you factor in that $10,000 savings, really it's almost a wash as a whole. I mean, in net $10,000 off the cost of the loan, ultimately you're going to have pretty much the same. So rates are so good right now, it's a good time to really take advantage of it now. You know what you're getting now with rates. Prices are very good. We don't know where rates are going to be in the future, so we ultimately want to try to take advantage of it while we have some certainty of what's going on. Basically, just in conclusion, I just wanted to say that rates are still very good. We continue to see a lot of challenges out there in the marketplace, but things are improving. We are seeing some stabilization out there, so that's positive. We are seeing kind of a back to basics, as I said, more shifting to conventional loans, at least 5% down. And there are still good core programs out there for the first-time home buyer, and those with little to no down payment, such as VA, FHA, rural housing. Those continue to be good. As I said, rates continue to be good as well. And contrary to what you hear on the news, banks have money to lend. Well, at least Dairy State Bank, anyways, has money to lend. So, if you want to send customers our way, we would love to sit down with them. So that's essentially my presentation today. I appreciate your time. That's it. Thank you.